Well, good morning. Good Monday morning. This is Market Day Report. I'm Scott Shelty, and I am still the cow guy. Lots to talk about again. We've got everything happening all over the world, especially things happening in this country. But why don't we jump right in and take a look at how the grains have been faring overnight going into this opening here this morning. So we've got corn basically across the board down 4 to 6, I would say, is fair. September down 4 3/4 cents at 542.5. December new crop down 5 1/4 cents at 537 3/4. And to give everybody a little bit of a reference, that December contract tried to close that gap last week, 50 cents higher, basically up at 573, and didn't quite do it and failed. So moving right along to soybeans. That soybean market also a little easier here, 10 to 12, 10 to 15 across the board. Let's start with August, off 10 3/4 cents at 13.90 1/4. September down 10 3/4 cents at 13.45 even. And we've got November posting a 12.5-cent loss at 13.39 1/4. What's the wheat market doing? Chicago wheat also easier, 13 to 15 lower basically is what I would say. We got 12.5 cents lower in the September contract up front, 671.5. And December's off 13 even at 680.5. How about Kansas City? Kansas City hard red wheat, that's coming in easier as well, 10 cents basically across the board lower. September down 10 1/4 at 635 3/4. December off a dime, March off a dime, May off 10 3/4 cents, to give you an idea about how that's rounding out. Spring wheat here in Minneapolis, up in Minneapolis, 9.5 cents lower, 874 last, about 14 cents off the highs, I'll give you a clue. December off a dime at 861 3/4. We are lucky enough, our first guest of the week, Brian Hoops, president of Midwest Market Solution. Brian, how are we going to kick this week off? What are you talking to your customers about? I mean, there's a load out there. And we also have some outside markets that are kind of winging about. Not anywhere near what we had to say last week, but definitely some headlines. What are you talking to your customers about this morning?
Yeah, good morning, Scott. From calls that we've talked with clients last night and this morning already, there's certainly going to be some yield loss in some areas in the Western Belt. It's a very frustrating time for the farmer who has not received a lot of rain over the last 2 weeks to see this heat roll in. Going to be 100 degrees in a lot of areas, and they are probably going to experience some yield losses. And I'm an old Iowa farm kid, and you can tell, from historical tendencies that you get this type of heat without much rain for subsoil moisture for the crops to absorb. It's going to be a struggle, I think, for some of these crops. So I think the USDA is overestimating the size of this year's crop, but at the same token, I think prices are going to retreat in here until we get a little bit closer into harvest. The funds are in more of a liquidation mode, and that is one of the things that's driving these prices lower. We're going to have times where we're going to see prices move higher, but there's a kind of an uptrend line for soybeans to fill and go touch maybe another 40 cents down from where they're currently at. So we may see some more technical weakness despite the fact that there's this heat rolling into the Midwest, especially the Western Belt.
Yeah, it's that argument, that old argument you have with yourself, right? That there's something you can feel, touch, and see versus what the perception may be a week, 2 or 3 weeks out. That's really the tug of war that we're having right now. And so far, it feels as though the perception of better weather is winning out in the short term. And that's probably due to the fact that we haven't surprised the market with any new hot and dry weather. It's just been hot and dry every single day. And the market's getting a little bit complacent, I think. Would you agree with that real quick?
Yeah, absolutely. I think the market has kind of absorbed this, and it's these longer term forecasts have been a bust, and so market is really kind of just ignoring some of that. There's been talks that China-U.S. relations are ongoing. There's some trade agreement talks going on. Mm-hmm. They haven't gone well. That's not a surprise, I don't think. And anytime when we have these poor relationships, it seems that China does step in and buy some product from the U.S., and so maybe the prices move lower here. They will step in and we'll see some announcements.
Okay, well, we're going to take that as a great spot to take a quick break here. Thank you, Brian. We'll be back after paying these bills to talk with Brian Hoops about the proteins. Come back with us. Welcome back to Market Day Report. I'm Scott Shelty. Thanks for joining us. We're still here with Brian Hoops. I'm going to go over some of these livestock prices. That's where we closed out the week. We're not quite open yet, but we had a cattle on feed report on Friday, so we're going to have to bring that up as well. So let's talk going home on Friday, the live cattle market Well, the live cattle market was up a tad, and I think that the cattle on feed report for feeders and the likes is going to be a little mildly supportive, so maybe we'll see these contracts trade in that same vein here today on a Monday morning. But August was up 70, October up 47 cents, October went out at 127.15. Feeder cattle, let's take a look how they went home on Friday. They were also higher, and they had some pretty good gains, up $1.87 in August at 160.07, and September was up $1.82 at 162.52. Let's take a quick look at how we went home with lean hogs. We'll get back to Brian. It looks as though we had some kind of gains in sympathy, I'll say. 70 cents higher in August, and October was 90 cents higher at 92.62 in that October contract. But you have to go out to say the deferreds. Maybe April starts to post a small loss of, say, 17 cents. Brian, cattle on feed, what are your thoughts? Where do you think this is going to play out this morning? How are you expecting things to open up?
Well, compared to our expectations, it seems to be a little friendly. Placement numbers about 3% less than what the trade had expected. So I think that's a number to watch. That should be very, very positive. But you look at the numbers overall, it looks like the tightest supplies of the year could occur in December. We are entering a stage where supplies are going to get much tighter, I think, right now into the third, fourth quarter of this year. And as the supplies tighten up, maybe the futures market can add a little bit of premium. We have a pretty substantial market already, with looking out to February 137. So I think you get a rally back up near some of those old highs, D's up around 134, 135. Good time to be slapping some put options underneath it. As the market's always going to anticipate what we know today, that these supplies are going to be much tighter in that time frame, and it's a futures market. It's going to anticipate that maybe these supplies get a little bit larger after that time frame.
I would totally agree with you. Thank you very much for that. And another last thing is that you never kind of want to. It's been kind of quiet over there. You never want to get short a quiet market. That's an old floor saying. Maybe we'll go by that too. Brian Hoops, thank you very much. Brian's the president of Midwest Market Solutions. Thanks for joining us today on Market Day Report. I'm Scott Shelley. We're going to hand it back over to Janet. Thanks.